steps in trading, dear friends. I hope that we are doing great and I hope all is well. So we have done an analysis of a number of instruments in the financial markets. In the initial video of this particular series, we did an analysis of the stock market, starting with the European stock market, and we delved into the US stock market, and then we went into the currency market, specifically major pairs or pairs that are measured against the US dollar. And in this particular video, we're going to go into the commodity market, where we're going to focus on instruments like gold, crude oil, and we'll see if we can also tap into silver as well, so analyze silver, and we'll look at Brent oil, the UK oil, and also crude oil from the US as we begin to analyze. In the previous video, we dealt with the currency market, both the digital currency market and both the actual currency market, the markets that have to do with currencies that are traded on live physical markets. So both instruments, both the digital and the traditional currency market, both have their expression in financial instruments in the financial markets. So we've dealt with all of these, so we're gonna just rub these out, and we're gonna focus specifically on gold today, and also gonna look at UK oil, gonna look at US oil, we're gonna look at silver as well, and also delve into silver. Is there anything that I have left out? I don't think so. From the commodity side, I think these are the mostly traded commodity instruments. So let's go right into it. So I'm going to copy and paste our checklist. We've developed a checklist that is quite different to the initial checklist that we had, and it'll be quite interesting to see how this plays out. Okay, so we already did some pre-marking from previous price action. So what we're going to look at here specifically with the gold market is key transitions. So first of all, we're going to mark the beginning of London session, the beginning of the European session. So here specifically, this is where Frankfurt started, this is where London started, then this is where New York session started, and this is where London session ended. So for the rest of time, we have that aspect of New York session being the focus. We have that aspect of the price action from New York session being the focus for the rest of the day after London session ended. Okay, so we're going to draw our checklist once again, and I'll paste it here. So first of all, we're looking at liquidity to establish the interest. Who is interested in the market at a particular point? Is it buyers or sellers? And we're looking at the interest from the point of liquidity sweeps. After liquidity sweeps, we're now trying to look for liquidity pools above or below liquidity sweeps to establish a liquidity pool from an order block that now becomes a price area that established a certain kind of trading activity, or that confirmed trading activity in a particular from either buyers or sellers. So it established either a buyer's market or a seller's market. So liquidity will establish the kind of market that we're going to have in a particular moment of the day. So we're establishing liquidity sweeps, and we're seeing liquidity sweeps and liquidity pools from session to session transitions. And that's an important thing, is that when we're analyzing intraday activity, we're analyzing session to session transitions. And if you watched season 1, which I highly recommend, you will notice that there are 4 major sessions. So we have Sydney, or 5 major sessions. Had a tongue twister there. We have Sydney session, at which Australian traders are active. We have Asian session of which Asian traders are active. We have Frankfurt session where European traders begin, particularly those in Germany. Then we have London session where traders from the United Kingdom region and that aspect of Europe become active. And then we have New York session at which US traders become active. Now these sessions were established because these are the areas of highest economic value. We don't have an African session yet. Maybe there will be one day based on how the stock market and the markets they evolve. But for now, as it relates to the highest level of traded activity, we have these 5 major sessions that are marked in terms of economics. Okay, so now we're going to focus specifically with gold spot against the US dollar. We're going to focus specifically on the US market and see how there was how transitions took place from there. So we're going to focus on how price action continued in a particular direction from this particular point here. So first of all, we have to establish the liquidity sweeps that happened. So first of all, what we can see is that sellers were swept out of the market, or selling prices were swept out by buyers who entered into the market. So we can see that the sellers here, because there's a high chance that by the chance of people selling at that particular price point, there are going to be sellers there, but let's just say the selling price for the sake of not being speculative but rather being exact. We can see that the selling price here was invalidated by the buyers who entered into the market at this particular point. So they invalidated this particular price, and we can see that happening all through London. So after the liquidity sweep, what we're now trying to identify is a liquidity pool or a price area that particular trading activity began, and that is this area here, which will now be marked as our POI, or price of interest. After we've established the interest, we now establish the price of interest, the price at which that interest started. So we established that this is now a buyer's market because of sellers being invalidated and selling prices being invalidated. This becomes a buying market, right? And then what happens is that once the buyer's market is established, the price point of interest becomes this price area here that established a buying market. And for the continuation of buying with efficiency, people are going to place a majority of their buying positions at this particular price because that is the price that established the buying market. So using our favorite example, if I'm selling sweets to children at a school at $5, I have to maintain that same price range in order for me to get a continuity of interest from those people. Why? Because the market that established in that particular environment was the $5 price. So if I'm going to sell to that same school at maybe 12 p.m. recess rather than 9 a.m. recess, at 12 p.m. I have to maintain the $5 price. Otherwise, I would shift the interest. So that price range is the price range that's going to continue the interest of buyers in that particular market. And this is what we now begin to see in this particular day, is that buyers continued to buy at this particular point. There was a certain level of buying throughout, right? But significant buying or direction continuation or trend following buying or trend continuing buying only happened at the highest volume of buying happened in continuation of the buying that originated here just before London session. So just before London session, we can see a sweep of the selling price and selling price liquidity or sell side liquidity, which now established buy side, which is now established buying, which is now established a buyer's market, and the buying price point becomes the price point of continuation, and that is what we see here. So this was about a 50 50 pip price range, and then the market moved about 20 or 200 pips, right? So at that point there was at least a 1 to 4 risk to reward move. So I hope we're starting to see how we are pairing analysis with analyzing the day trading models. And once again, we're analyzing these moves post-market, and it's intraday analysis we're focusing on. So now let's delve into the oil market, right? Let's delve into the oil market, and again, we're gonna paste our checklist: liquidity to establish interest and price, volume to establish the amount and commitment of trading at particular price points that established that particular interest, volatility, the price reaction of trading activity, market structure is the direction evidence of that trading activity based on liquidity, volume, and volatility, and in equilibrium price is the price of interest that determines the pattern of trading continuity. So it becomes the price point of interest for people to continue buying in that particular market. This is all just economics, and I hope we're getting to some level of understanding as it relates to this. Okay, so this is UK oil, right? So we're gonna focus in this particular moment specifically on how London session started. So London session started here because obviously the traders who are dominant at that particular point would be traders from London. So what we can see here is that there was an overall selling market, but one thing that's also very important is that whenever you are picking a price of interest or a POI as an analysis point, you're trying to see how price is reacting to a particular price point, you first start with the recent sweep of liquidity, because the recent sweep of liquidity, it establishes a certain transactional moment where people are transacting with a particular instrument at a particular price. That particular price has interest for that particular moment. So starting with the most recent liquidity sweep can be effective, especially when it comes to specific instruments that have trading activity at specific moments in time. So what we can definitely see here is that from Asian session, the most recent one was one that carried through all the way from Asia and then poured into London. So what we can see first of all is that we can see a liquidity sweep here. And what you notice is that liquidity sweeps basically have the same, because remember, market structure is just evidential data of what liquidity, volume, and volatility are doing together to establish the market environment. Market structure is just the data evidence of the market environment set by liquidity, volume, and volatility. So what we can see is that this liquidity sweep evidenced in the break of structure. So whenever you're seeing a break of structure, have this in the back of your mind, is that there is a liquidity sweep that has happened, establishing an interest and a liquidity flow based off of a price block that happens above or below that liquidity sweep. Below if it's a buying market, above if it's a selling market. There is a price above that established sellers, and a price below that established buyers to take and establish their interest in the market. So in this particular moment, we can see that a seller's market that shows us a bearish break of structure, and then at that selling point or at that selling price block, what we can see that there was a volume of sellers or selling positions in the market that moved the market in a bearish direction, and that bearish price reaction is the volatility expansion in a bearish direction. So I hope we're seeing how all of this pairs together. So what we can see here is that sellers dominated this market by sweeping the buying price, which would the buying price now becomes the buy side liquidity, right? And then once we've established that, we now mark this particular price block as a price block of interest for sellers who started, because remember we're looking at the order block that was the origin point for a particular volume of trading activity that introduced a certain amount of volatility in the markets. So we can see that this introduced a certain amount of volatility in the markets. And then what happened now is that after this sweep of liquidity, so we can see that even into London session, there was still wasn't a sweep of this liquidity, but this particular price point only becomes a strong point once liquidity here is swept. And we're still going to mark this as the price point of origin. Why? Because sometimes what tends to happen is that the price can be revisited because people may still want to buy at that or sell at that particular price at this particular moment. So people in Asia establish this as the price point of interest for their selling interest. Evidenced in that sweep of liquidity means that they are dominant over buyers. And as price returned back to that price block, we can see a continuation of the selling activity with a further sweep of the buying price here, which would be, so it means the buyers who were here and the buyers who may be there will be swept by the selling activity that is happening here. So we can see that in the beginning of London, that position was placed in the markets, but only for a temporary amount of time before buyers came into the market. And we can also see a similar concept as well here, is that pre-New York we had a position that was now taken as an equilibrium price point for the continuation of that buying activity here. So it's a pattern in the markets. This is economics. It's not superstition. These are the laws of economics playing out in the markets. And I hope we're seeing how practical economics is, even in the financial markets. Right? So we can see liquidity swept here, selling side liquidity swept here, and also the liquidity that was here from the previous day was swept as well by the buying that was happening here. And then from the transitional point of one particular price point, we can see this becomes a price point of interest. So we see that buying activity happening into the beginning of New York session, comes back and then continues. So from London session, the selling that was taking place in London session had so this was about a 10 point move, and then it moved for about 40 points or 40 pips or 400. Sometimes I mistake how to calculate these points, but what we can definitely see, actually a 1 to 3, not a 1 to 4, a 1 to 3. So we can see a 1 to 3 risk to reward return on this sell that happened in London session. And then from New York session, we do have a bit of a bigger position. So this was about a 15 point move, and then we have about a 50 point move. It's also about a 1 to 3, about a 1 to 3 point move when the markets reached there. So there was a 1 to 3 opportunity both on the buying and selling side on the same day. So you can see how key moments of time are important. Key moments of economic activity are important. That's one thing that's very, very key to understand. It's a key point to understand. So that's on UK Brent oil. Can we see similar activity happening with US crude oil? We do see pretty much identical price action, but what we do see when it comes to New York session is that New York didn't really have an established price block or price area that it was reacting off of. That was like like an order block. So it invalidated the buying activity here, but it did buy. But the more efficient pricing happened on Brent oil. So I hope that makes sense. And then when we go to silver, we may also see again similar activity to gold, but it will be interesting to see what happens here. So we're going to focus particularly on how New York session was carried about, So New York session started here. We're going to focus on this particular position. So what we can again see here, first of all, is a liquidity sweep. So buy sell side liquidity here was swept, revealing that it's a buyer's market here. And then once that buyer's market was established, we now begin to take note of this particular price block that was tapped into, but tapped into again, where at this particular point in time, pre-New York, but also into New York session. So you can see this particular price block was tapped into 4 times, but the direction of trading activity still continued in a bullish direction. So a price point can be tapped into more than once. Doesn't mean it's weak. The only time you would say that it's no longer useful is once it's been invalidated by the opposing force of people who are doing the opposite in the market. So that's an important principle in analyzing the financial markets, as you're deriving an hypothesis, not a hypothesis, but you're deriving a analysis of what was happening in the markets. So we can see that there was a sweep of liquidity, and then we established that the volume of trading activity here was maybe not the most convincing because it was more of like ranging price action, but we can still see it had effect enough to sweep liquidity. And once its liquidity was swept, the volume of trading activity was enough to sweep liquidity, and then volatility expanded in a bullish direction, retraced in a bearish direction, and then continued back in that bullish direction, establishing that continuity of trading activity. The price range was about 23 pips, and then we have at least, I would say at least a 1 to 3 risk reward with this move, right? At least a 1 to 3 risk reward here. So we can see how these concepts apply, and I'll put this once again so that we can see the principles we're applying: liquidity, volume, volatility, market structure, equilibrium, price. So I hope this video has brought about some value to you and has shown you how supply and demand works even in the commodity market. On the next video, we're gonna introduce some other assets, and then we will see how those particular assets, even if they may not be the traditional assets, but how they react with the principles that we are laying out, the 5 principles of liquidity, volume, volatility, market structure, and equilibrium, price. All right, dear friends, have a blessed one. May God richly bless you in Jesus' mighty name. Amen. Cheers, guys.